The low interest rate market has created a real opportunity for Canadians to get into home ownership. According to the Bank of Canada, in December of 2011, Canadians held approximately $506 billion worth of mortgage debt with the Charter Bank, compared to $468 billion in January of 2010, which may indicate that Canadians are looking at this as a good time to invest in real estate. There is a growing concern, however, over the unprecedented debt levels that Canadians have racked up. And the low rates, if left unchecked, can compound this issue by creating a skewed sense of affordability. Some fear that Canadians are buying bigger and more expensive homes simply because their mortgage dollar stretches further when the rates are lower. So that, is something that we need to engage customers on and engage Canadians on and help them understand how their affordability impacts them today as well in the future. So if the rates go up in the future, Canadians need to better understand how they can afford their mortgage today as well. If their mortgage is up for renewal, what does that mean in terms of increased mortgage payments? There are a number of strategies that we can engage or help Canadians understand their affordability and their manageability with their mortgage in the future. First, of course, is help them understand how they can use the low interest rates to pay down their mortgage debt faster. They can increase their mortgage payments. They can use lump sum annual privilege payments that their lenders will allow, as well accelerate their payment frequencies to perhaps a biweekly or a weekly rapid so that you can get ahead of your mortgage principal before renewal. Another strategy is, of course, to anticipate future payments. So use online calculators to better understand what your mortgage payments look like today, as well anticipate future payments by increasing the interest rate by 2 or 3%. Because that exercise will help you cushion and budget for future rate increases. And finally, look at the opportunity in the rates to lock in for longer if you feel that your life stage might be changing in the next few years. So for example, if you might be retiring, you want to lock in for longer so that you can count on the stability of your mortgage payment not changing through that time. One area of caution is if you do decide to lock in, make sure that you've understood what flexibility you may have with your mortgage if your life circumstance change.